Hello, everyone, and welcome back. My name is Greg Furman, and this is the VantagePoint AI Market Outlook for the week of August the 16th, 2021. Now, to get started this week, we'll begin where we always do with that very important US dollar index. Now, as I discussed in last week's weekly outlook, a known cycle that I've seen in the dollar over the many years that I've been doing this is that the week after the non-farm payroll number, that real dollar demand dries up and the dollar is left to fend for itself. The dollar clearly did not do well. However, the event risk that we're going to be dealing with this week is the FOMC minutes. Now, those minutes could be still bullish for the dollar, but as we can see, the VantagePoint software with the medium term crossing the long term predicted difference with the neural index and a falling RSI has led to a significant move lower on the dollar on the Wednesday, very much what was suggested in last week's weekly outlook. And again, this is a cycle in the dollar that most systems don't pick up on. Waves, Fibonacci, this kind of thing. They don't see this coming. It just all of a sudden turns. But the MA diff cross warned us that this was coming. The slope of the predicted difference on both the main one, the medium term predicted difference, this pink line, as it starts to slope down and then crosses over the blue, that tells us the medium term trend is weakening against the longer term trend, making it somewhat easy on Euro longs, Great Britain US longs, US CAD shorts, etc. But where we go from here now, this can also be to some degree profit taking on Friday ahead of this coming event risk. So the level that we want to watch this week very closely is that T cross long, 92.59. Can we hold it below that or above that? That is the key thing. Now, if we click on our F8 in our software, we also have the long predicted, another powerful pivot area. That's coming in at 92.75. Now, assuming that the dollar will follow its normal cycles, we can look internally into some of these markets and say, okay, if the dollar does sell off, what markets are likely going to follow with it? On a year-over-year basis, we can see the ProShares Ultra Short Euro, 98% correlation, US Singapore, US Israeli Shekel, and US Swiss franc, Metro stock, US Mexican peso. If the dollar goes down, the theory here is that these would follow. Now, again, the inverse correlated ones, you can also see that we've got Imperial Metals, Aussie US, Aussie futures, New Zealand dollar, New Zealand US futures, the Euro, Euro US dollar. So these currencies would all turn higher if the dollar moved lower. That's the inverse correlation. So when we look at this through the eyes of neural networks, we can get a better idea of what we can expect. And again, by clicking on the stock sector, I can click on the Forex, I can go to ETFs or to the futures markets. These are very powerful tools that in most cases trump conventional indicators. These intermarket correlations can be very hard and very fast. Now, we can also further assess that I continue to leave the 52-week look back on the screen, but I've modified it to 31 weeks. We've got the price on open, which is 92.77. That's the opening price for the week. So the dollar is actually closed down on the week despite that very strong payroll number. But again, I did warn everybody of this cycle that I've seen when institutional funds dry up, they no longer are required to buy dollars, then the dollar must fend for itself. Now, there was a very well written article in one of the VantagePoint blogs this week about the history of the US dollar, its decoupling from gold, the gold standard, a very good read, and it just basically discusses fiat currencies. But always remember, with all of these fiat currencies, we're looking for the prettiest horse in the glue factory to some degree. And right now, that doesn't appear to be the US dollar. Now, with the dollar moving lower, we can see that gold immediately responded to this. Now, I will advise here that there were a number of discrepancies on the market open last week. And if you see anything funny with your broker, around the price action between the market open, which would have been around between 6 and 7 o'clock last Sunday night. The market came all the way down to the level we anticipated, but it did it within the first bar, the one bar on your MetaTrader software, some of the European brokers, I noticed that they moved that price over into the second bar on the hourly bars. That actually didn't happen, guys. It took place immediately in the one bar. As soon as the gold futures opened up around 6, I believe, on Sunday night, it immediately crashed lower, people running for the exit. But as you can see, that was very, very short-lived. Once again, the medium term crossing the long term predicted difference has taken us right back up. But much like that dollar index, we're stalling here right on the T-cross long at 1780. So it's likely that gold is going to be waiting to get those FOMC minutes before it can overtake this level, but it certainly is a very, very strong recovery. And that also is consistent with the 31-week low at 1677 that we discussed in last week's weekly outlook. So a very good buying opportunity off here. But I prefer to wait for confirmation from the VantagePoint software with a powerful indicator like the MA diff cross. But as you can see, the RSI is not overtaken the 60 level, so we're losing momentum as we come up against a very, very strong resistance level at 1780. Now, the star performer yet again last week, and again, Bitcoin continues to outperform most other markets here. Now, despite the dollar strength, it was completely unfazed. Bitcoin continued to extend. We've had a nice move off that weekly opening price, that price on open, 43,970. Going into next week's trading, again, you can see using the verified support zones, we don't have a lot of resistance here, guys, between where the market currently is and the 31-week high. Now, the 31-week high is 64,789. I don't, to be clear, I don't think we're going to get there next week, but it certainly does look promising that we can extend higher. Now, again, as we back these charts out on Bitcoin, which is I would strongly recommend you do, you can see the structure of this. So this resistance point right here is the one I've got my eye on, 59,558. If we continue to move towards that level and we fail just under that level, then you're going to see likely a deeper corrective move on Bitcoin. But again, I would strongly advise everybody read that blog about the fiat currencies that was posted in the VantagePoint blog this past week, because that article does discuss Bitcoin at length. Many of the things that I've discussed on here, the annualized return, some over the last 10 years, some 230% per year. It has been the top asset class, despite comments from Warren Buffett and some of the people that work for Warren Buffett. I truly believe that if you can read a chart, then you would be a Bitcoin buyer for at least the last 3 or 4 years. So again, when we're looking at this right now, that T-cross long is at 42,292. If we click on our F8 in our software, we can get an additional pivot area, and that's coming in at 45,499. But I will say that I still do see a very strong positive correlation between Bitcoin and the US dollar. So this dollar weakness, if it does take a deeper corrective move, that could affect Bitcoin. So I would continue to watch that very closely and these key vantage point levels. Now, when we look at stocks going into next week, more specifically the S&P 500, there just doesn't seem to be anything to stop this thing. It just keeps going back higher. We're continuing to set new yearly tops. But again, it still continues to move higher. A little bit of concern here is the medium term and the predicted difference are basically piggybacking on each other. Neither one of them are budging. The RSI is at 88.1, but once again, guys, this is another example of why we stay away from overbought and oversold type of indicators, because again, you're trying to tell the market to stop going higher and go lower. We can see that when we hit an overbought condition like this, or we reach accumulation distribution, again, the market just completely disregarded it and continued to advance. So longs clearly still the better play, but my concern is that at some point we are going to have a much deeper correction. Now that could come as early as Wednesday if those FOMC minutes have a different rhetoric to them that they are looking at raising rates sooner. The economy is doing better than what they thought. But that's still, even we've already had that, guys, and it's the stocks continue to push higher. So right now, the T-cross long 44.13 is our major support level between bullish and bearish. When we click on again our F8, we can see how the market is just basically bouncing off this blue line almost on a daily basis. Each one of these represents a daily long trade here and then going back to cash. That is a very effective way to use the software. We can further assess that the weekly opening price at 44.37 easily closed above that also. So we'll continue to monitor this, but for now, longs clearly are the better play until such time as the Fed changes his tone. Now, as we look at light sweet crude oil, again, I believe that next week, light sweet crude oil should turn around and continue to advance here. We had a very, very nice MA diff cross here just a few days ago. Pink line crossing over the blue line that immediately, with virtually zero lag here, guys, led to a move higher. But as you can see, we must clear this T-cross long at 69.62. If we can do that, then we should be able to get back up towards the 74.23 mark without too much trouble. I would expect we would be there later in the week after the non-farm payroll number. Now, as we look at some of our main currency groups here, starting with, of course, the number one traded Forex pair, which is Euro-US. Now, again, you don't have to be, a graduate from Harvard or, throw 50 different indicators at this thing. You just need to understand, guys, overall ranges and intermarket correlations. The euro has a high correlation to gold. As gold started to rebound and the dollar index started to tank on Wednesday, the euro immediately responded by turning around. But once again, we have an MA diff cross with the neural index and a rising RSI. The euro could be getting ready for a bigger push to the upside, but we must clear the T-cross long at 1796. Be very cautious of a false break here because of those FOMC minutes. So if we get a big push on the upside on Monday, which I suspect we will, that doesn't mean it will still be there on Tuesday. So again, be very, very cautious. But if we can close above 1796, then we should not have too much trouble getting back up towards the 119 area. You can also, again, click on your F8 in the software and you can find a very good entry point for Monday on the long side of this. What we're doing is matching the long predicted at 117.63, and then you can match that to the predicted low, which is 117.64. Easy peasy, guys. Right or wrong, good, bad, or indifferent. You can buy off that particular level and make sure that your stop is below the 31-week low, which is 117.04. That's the way you would look for a trade setup. We do not use the predicted highs and predicted lows as stop loss points, guys. We're always using either the long predicted or the T-cross long or both. And again, in this particular case, with that 31-week look back, all I'm looking for is the low of the year and the high of the year. The low of the year is that one set down into that 117.05 area. The high for the year on the 30-week basis is 122.84. This makes longs very attractive down at this particular level. Now, the same thing would apply to US Swiss franc. You can see that it's turning the other way. As the euro goes higher, then the US Swiss franc, it turns lower. Now, we've stalled right on the T-cross long, which I don't believe is a coincidence at all. 91.50. So we're looking for 91.50 to hold. But I think that that's unlikely because as you can see, before the market opens on Sunday night, this video is being done on Saturday, guys, ahead of the market. This is not... This is an outlook, not a recap of something that already happened. So we're looking at this from a trade perspective setup, that this is warning us that the medium-term trend is weakening further and the neural index is in agreement. We've got a falling RSI. The only thing holding this thing up from falling off a cliff is 91.50, which is the T-cross long. So if we break down below that, we're likely going to take another run or another stab at the 90.18 level. I would say that there's a strong It's very likely that's going to happen. The only one that could change the direction, the course of this move would of course be the Fed. Now, with the British pound US dollar, once again, you can see that we've closed basically right around the weekly open. This point on time is set to the weekly. Now, again, we've got our medium term crossing our long term, or about to cross the long term predicted difference with the neural index, but it's struggling in here. Right now, I can see some pretty good support stacking up down here around this low, around 137.95. So again, if we click on our F8, then we can see that our predicted low is 138.29. I think longs are very reasonable to start the week based around this particular setup. Now, in this case, our 31-week low is 134.52. Our 31-week high is 142.47. So it would appear that we're at least going to take another stab at this 140 level, but this 140 level has been very, very stiff resistance, and I'm not convinced that we're quite ready yet to break through that level, but longs carry a slight edge to begin the week. Now, with the dollar yen, usually some say it's a very good barometer for measuring dollar strength. I think it's great for measuring gold and some of the other commodity markets. But as you can see, the dollar yen started to really struggle on Wednesday after the Tuesday after the non-farm payroll number, where I suggested that monthly pattern that I've seen, and it's not 100%, but it sure is about 80 to 85%, that when that institutional money is no longer looking for US dollars to settle government pensions, pay government employees, settle trade balances, then the dollar just mysteriously seems to just disappear. Now, the dollar bulls were just saying this is it, the dollars are going to break out. As you remember, I was not in that camp then, and I'm not in that camp now, because I've studied these seasonal patterns, and these patterns tell me that the dollar very well may go higher, but not until it does one of these first. So again, the dollar yen struggling with that weekly open, then it broke down below the T-cross long at 110.04, so that now becomes our resistance point to begin the week. But again, that MA diff cross with the neural index and an RSI that is showing downward momentum, this also could point to another spike in gold prices, because we know that there's a very high correlation between the Japanese yen and gold contracts, and it's a positive one. So if we look under the hood a little bit with this dollar yen, you can see that there's a lot of different things: gold miner ETFs, the Spider Gold shares, and a number of these other pairs. And if you look at the direct intermarket, the positive correlations, and then the inverse correlations, you can see that all of these different markets down here, and we can go through that from the quarterly. You can see you've got Royal Gold, you've got Kirkland Lake Gold, I don't even know what that is, Barrick Gold. So on a quarterly basis, there's a very high correlation to the yen and gold prices, and that's where it shows up in this particular pair. So we don't want to discount that, because if we understand intermarket correlations, we can skip some of the indicators, so to speak, and we can get directly to the trade if we can anticipate. So if the dollar yen does continue to fall lower, then gold is likely to break above the aforementioned level. Now, if we anticipate the equities will continue to move higher, and that would likely mean that oil is going to recover, then US Canada shorts obviously would be the better play. Now, if we look at this past week, this yellow line represents the weekly opening price. You will get that in your VantagePoint software on Monday night when the market closes. It will show you the close from Monday and the open from Monday. That's the start of the trading week. The point in time or the open price on time, we'll put that in there automatically. So when we look at this now, we can see that US Canada is looking quite bearish yet again. Another MA diff cross with the neural index. There isn't a lot of momentum here though. So what we'll be looking for from this is for the RSI to break down below that 60 level so we can start building momentum to the downside. But again, in summer driving season, I know we've got the Delta variant and things are getting a little shaky again, but the oil companies are not going to let the prices at the pump go lower at this time, and not usually until uh, end of September or October that oil prices will start backing off a little bit. So barring anything more from the COVID virus thing, the Delta variant, then oil and equity should climb, both of those being positive for the Canadian dollar. And remember, the Bank of Canada has been very vocal that they plan on hiking before the FOMC does. So that's another advantage for the Canadian dollar here. The only thing that could change this is if oil crashes and stocks crash. That's what will ultimately drive this particular pair higher. Very sensitive to again, oil prices and equities. But for now, I would say that a retest of this low is imminent down at this 124.22 area. And just remember, if you've been in the VantagePoint Live training room, I've also shown people these crazy reversals with US Canada, and I see them almost every week. And there it is, big bull bar on Monday, and then on Tuesday a big sell-off. So whatever it often does on Monday, this pair often does the exact opposite on Tuesday. The same applies to oil prices. I've seen a very similar pattern with light sweet crude oil. Now, as we look at the Aussie US and New Zealand US, very, very similar trade. Once again, the Aussie needs a bigger spike in, it needs gold recovering and it needs equities to keep moving, but we still don't have a lot of buyers on with the Aussie US. But we may be coming into a bottom, but this low, this 31-week low, which is now coming in at 72.89, just make sure that if you are buying this pair, you're keeping your stops below that 31-week low. But right now, the immediate problem this pair has is getting past 73.75. The 73.75 is the T-cross long, and we see something very, very similar with the New Zealand currency. But the New Zealand currency, between these two pairs, this is a rarity that I actually see different signals. In most cases, these two pairs, they go up and down together. But you've got the RBA, the Bank of New Zealand. There's a lot of rhetoric going back and forth, which is causing a little bit of a variance. But also the Australia-New Zealand cross pair is definitely affecting these two. So with the New Zealand, you're looking for this particular pair to hold above the 70-cent mark. If it can hold above 70 cents, then the New Zealand should be able to move higher on dollar weakness, but the Aussie still may be better value. But again, the main event risk that we're going to be dealing with this week is going to be the FOMC minutes, and I would always expect the unexpected with them. So with that said, this is the VantagePoint AI Market Outlook for the week of August the 16th, 2020.